The much hyped data on mutual fund stress test results for mid and small caps are coming out. And as expected, the media has started putting out reports on which mutual funds have a higher, liquid days to liquidate, number of days, and also the fund houses that have a very low number of days to liquidate. Now, what's all this about? And before you make any conclusion or decision based on this data, here are a few things you need to know about. So here's the first thing. I have with me a bit of data that we have compiled thus far. Data keeps coming in, so this may change. But if you see that here are some fund houses, which this data says takes, as long as 30, 35, 60 days to liquidate the 50% of their portfolio. For example, take the very popular small cap fund SBI small cap. It takes about 60 days to liquidate 50% of its portfolio is what the data says. So this exercise essentially means that if there is a rush for redemption, even to liquidate half of its portfolio, the fund house is going to take 60 days. Now, is it something shocking? We don't think so. When we see this data, we have to understand the context in which we are seeing the market cap segment for which we are seeing this. And this is where it is necessary for you not to panic and understand just a few factors that really bring out these numbers. Now let's look into the first factor, which is the asset size. Just look at this number and you will understand that of the data that has come out, you have your Nippon India small cap with 46,000 crore of AUM. You have SBI small cap with 25,000 and odd crore of AUM. What does that mean? They have a very large asset size, and there is a very large asset size. Basically, it takes time to liquidate, right? This does not necessarily mean that all the shares that they hold are illiquid, but because their sheer size is very large, they will take time to liquidate. Should this shock you? I don't think so. For one reason, these funds are entering a market cap segment which is very small by its very nature. The traded volume in these are not very high. Mutual funds try to pick those that are little large. They stick to the slightly larger ones, and yet when your asset size is large, naturally your ability to quickly liquidate will be low. But does it mean that these fund houses are getting into poor quality stocks and therefore they're not able to liquidate? This data definitely does not, should not make you conclude, that the quality of portfolio is bad. So that's one thing that you need to know. And the second thing that you need to understand in this is the the proportion of small cap stocks that these fund houses might be holding. Let me just get into that data. Here, if you for example see Edelweiss small cap, right? This data is sourced from MFI Explorer ICRA as of February. You will see that the proportion of small caps is about 67%. The much larger market cap segment, slightly larger at least, mid cap is about 30%. Right, as opposed to it, just let's take SBI small cap. About 80% of its AUM is into small caps. Only about 6 or so is into mid caps. It doesn't have large caps. Look at some of the funds here. Many of them will hold large cap stocks, right? So what happens when you hold large cap stocks? Obviously, the ability to liquidate will be much higher because these stocks enjoy higher volume. But what also happens is that these funds may not entirely participate when small cap rally happens, right? The ones that hold cash, the ones that hold higher large cap. So so you cannot blame those funds that are holding higher small caps, because that's what their mandate is. So if you look at funds here, DSP small cap holds 87%, so SBI small cap holds 80%, Tata small cap holds 93%, and so on. If you take say Nippon, it is a little more careful. It holds about 67%. But the fact of the matter is the proportion that you hold in small caps will matter, right? So and therefore, if I go back here, if I see Edelweiss small cap, yesterday I saw a comment which said, Edelweiss small cap is probably well managed. I mean, the fund manager has taken a call to get into lesser of small caps. Then that's a strategy call that they have taken. But as a result, naturally their days to liquidate is much lower compared with, say, SBI small cap. Is this reflective of the performance or the quality of the stock? Again, not necessarily, right? Because in this segment, this is exactly what you don't expect that the fund manager liquidates his or portfolio overnight. You expect the fund manager will pick winning stocks that will become multi-baggers over time, and that's the idea of investing in small caps. So just keep that in mind. The other thing in this exercise that you need to kind of understand is that the calculations here take into account that the volumes typically, when there is a kind of a market correction, is 3 times the normal value. Now this is an assumption, you need to note that. So what happens oftentimes is that post such a correction, the volumes dry up in stocks. So a fund manager may actually find it too difficult to even exit the stock for a long period of time. And we have in the past seen fund managers actually have trouble with that kind of exits. So the exercise, when it is done, you need to understand, is very theoretical. And this is not reflective of the performance or the portfolio quality in terms of the quality of stocks that they hold. What it reflects is a possible risk when there is a run in money. And please remember, a run in money in equity is not expected like the way it is expected in debt. In debt, for example, in 2018, when the ILNFS event happened, there was a run for money. And naturally, because there was a default or there was a risk of not getting back the money at all, people very legitimately, investors, withdrew money. But in small cap stocks, for every correction, when people, you don't expect people to be redeeming large sums unless you think the fund manager is doing a lousy job. There isn't a case, right? So the stress test, in our opinion, as far as you as an investor are concerned, should be one, viewed as a theoretical exercise to know the risk that a small cap fund takes in terms of its own liquidity. And please remember, liquidity is an inherent risk of the market. Just as a stock can be volatile, the liquidity in small caps can dry up, and this is a risk that you sign up for when you enter small caps. So you should be aware of it in the first place, and you should focus more on what is the risk level that you can take for your goal or for your time frame, and instead focus on whether the fund is able to deliver consistently for that goal that you have taken, instead of basing your decisions only on the stress test. The stress test as an exercise will let you know, okay, my fund does take higher small cap proportions, my fund is getting too large. Okay, so what if it is large? Is it impacting my performance? That angle, in our view, will be more important for you to consider than looking at this in an isolated way and making decisions. We will be writing more about all of these when we have more fund houses coming in. And if you want to look at specific data such as the proportion of small cap, large cap, mid cap, please check out our mutual fund screener at PrimeInvestor. You will get the proportion for each of the schemes. And if you want to place it in the context of AUM size, you will find that also. Look out for more in PrimeInvestor and do check us out. Thank you.